Just picture this, a single day where the political ground beneath two of the world's biggest economies starts to shake, and the aftershocks and global markets flying in completely opposite directions. Well, that's exactly what we just saw. While Asia was celebrating a massive rally, Europe was frankly drowning in a sea of red. It was a perfect storm, a real tale of two markets, and it all boils down to two political earthquakes.
And that's the big puzzle we're going to piece together today. How on earth can two major political shifts in G7 nations trigger such wildly different reactions from investors? One event lit a fire under the market, sparking a huge rally, while the other triggered a panicked sell-off. So let's dive in and break down what happened and, more importantly, why it happened.
Okay, so on one side of the planet, we've got Japan. The ruling party's leadership election served up a real shocker of a winner, Sanae Takaichi, a conservative known for her pedal-to-the-metal approach to economic stimulus. Then we hop over to France, where the Prime Minister, Sébastien Lecornu, just up and resigned after only 27 days in office, plunging an already shaky government deeper into chaos. Two huge political shakeups, two totally different market playbooks. Let's start in Tokyo, where the market reaction was, and I'm not exaggerating here, absolutely explosive. The election of Sanae Takaichi didn't just move the needle, it basically created a whole new market phenomenon, what traders are already calling the Takaichi trade. This wasn't just a small shift, it's a massive collective bet on a very specific economic path for Japan. So what exactly is this Takaichi trade? Well, it's the market's incredibly excited response to her economic platform, which people are already calling Sononomics. You can kind of think of it as the sequel to Abenomics, the pro-growth policies of the former Prime Minister Shinzo Abe. She is a huge supporter of aggressive government spending and wants the Bank of Japan to keep its foot firmly on the monetary gas pedal. In other words, the stimulus taps aren't just staying on, they might be about to burst open. Now, this trade really breaks down into three distinct, interconnected parts. First, stocks went through the roof on the promise of more government cash flooding into the economy. Second, the Japanese yen got a lot weaker because, let's be honest, why would you hold a currency with almost zero interest rates when you can get better returns somewhere else? And third, long-term government bonds sold off, which pushed their yields higher. That's the market basically saying, hey, we're a little worried about how you're going to pay for all this spending. And here is what that stock market euphoria looks like in practice. The Nikkei 225, Japan's main stock index, didn't just rise. It rocketed up an incredible 4.8% in a single day, smashing its all-time high. This was just a tidal wave of money pouring into the market, with investors betting that Takaichi's policies would be pure jet fuel for corporate profits. Now, for the second piece of this puzzle, the currency. The US dollar punched right through the 150 yen mark, a huge move of almost 2%. Now, this isn't just a number, it's a massive signal. The market is betting that the gap between US interest rates, which are higher, and Japan's, which are going to stay low, is going to stay wide. That makes it way more attractive for global investors to hold dollars instead of yen. So what's the real bottom line here? Well, it's all about what the market thinks the Bank of Japan will do next. Before this election, the market was pricing in a better than 50% chance that the BOJ would finally raise interest rates in October. After Takaichi's win, whoosh, those odds just collapsed to around 20%. The market is pretty much screaming that with her in charge, the era of cheap money in Japan is here to stay for a while. Okay, now let's buckle up and fly over to Europe, where, believe me, the story could not be more different. While champagne corks were probably popping in Tokyo, French markets were in an absolute nosedive. The Prime Minister's resignation wasn't seen as a catalyst for new opportunities, but as a descent into political chaos. Let's just pause on this number for a second. 27. That's it, 27 days. That's how long the Prime Minister lasted. This isn't just some political reshuffle, it's a powerful symbol of deep, deep instability and government paralysis right in the heart of Europe's second biggest economy. And the market's reaction? It was fast and it was brutal. The French CAC 40 stock index plunged 1.5%. Financial stocks, which are super sensitive to economic stability, got hammered even harder. We're talking major banks like Société Générale and BNP Paribas tumbling over 5%. Even the euro fell sharply against the dollar. This wasn't a precision strike, it was a broad, full-blown panic, a flight from anything with a French label on it.
This number right here is one of the most important fear gauges we have in the market. It's the extra yield or spread that investors demand to hold a French 10-year government bond instead of a super safe German one. Well, that spread widened to 86 basis points, that's 0.86%, a yearly high. This is the market's way of pricing in a lot more risk for France, and it makes it more expensive for the French government to borrow money.
You know, one analyst really put it perfectly. To lose one prime minister is misfortune, but four looks like a serious crisis. This quote just perfectly captures that growing feeling among investors that this isn't some isolated incident, but a pattern of governance failure that's threatening the country's economic stability. Okay, so we've seen the euphoria in Japan and the panic in France. But these are not just isolated local stories. They're feeding into a much bigger and frankly more worrying global narrative. A growing anxiety about government debt and fiscal discipline. Let's zoom out, because the global bond market is sending a very clear and very stern message to governments everywhere. And this is not just a French or Japanese problem. I mean, look at the data. Yields on long-term government bonds are climbing across the board, in the UK and even right here in the United States. In our totally interconnected world, fiscal anxiety is contagious. Worries in one major economy can and definitely do spread like wildfire. This whole global bond sell-off has led to talk of the return of the bond vigilantes. Now, this is a cool term for bond investors who basically protest a country's fiscal policies by selling off its bonds, which drives up borrowing costs. They act as a kind of disciplinary force, punishing governments they think are being irresponsible with their money, whether that's through too much spending, like in Japan, or through political paralysis, like we're seeing in France.
So, if global bonds are in turmoil and Europe is rattled, we have to ask, what's happening in the US? Because the American stock market seems to be living in a completely different universe. This brings us to the great American anomaly. Why are US markets showing such incredible resilience in the face of all this global chaos?
This chart really says it all, doesn't it? On the exact same day that the French market plunged 1.5%, the S&P 500 in the US actually finished in the green. So while European investors were hitting the sell button out of fear, American investors were still buying. So what's propping up the US market?
Well, a big part of the story is just pure sentiment. This is CNN's Fear and Greed Index, and as we can see, it is firmly in greed territory. This means that things like strong stock price momentum and high demand for risky assets like junk bonds are all flashing green. It tells us that, for now at least, US investors are choosing to focus on opportunity rather than risk, effectively shrugging off the turmoil happening overseas.
And of course, there's another huge pillar of support, the Federal Reserve. According to the CME Fed Watch tool, which looks at futures pricing to guess what the Fed will do, investors are still betting on a rate cut. This belief that the Fed has their back and will continue to provide support is a really powerful driver of optimism for stocks.
And finally, let's talk fundamentals. According to a recent analysis from Goldman Sachs, S&P 500 companies are forecast to deliver really solid profit growth of 7.2% in the third quarter. A strong economy and the ongoing AI boom are expected to help U.S. companies post better than expected results, giving investors a really good reason to stay bullish, no matter what's happening in Paris or Tokyo.
So, after a day of intense political drama and absolutely wild market swings, what happens next? Where do we possibly go from here? Let's wrap things up by looking at the key data points on the calendar that are probably going to dictate the market's next moves. Looking at the economic calendar from investing.com, there are 3 key events we really need to watch this week. First, on Tuesday, all eyes will be on Japan's 30-year bond auction. This is going to be the first major test of investor appetite for Japanese debt after the Takaichi shock. Then, on Wednesday, we get the minutes from the last Federal Reserve meeting, which could give us clues about their internal debate. And on Thursday, Fed Chair Jerome Powell speaks. The market is going to be hanging on his every word, searching for any hint of a future rate cut. And all of that leaves us with the billion-dollar question that's hanging over all the markets. We have clear evidence that political risk is giving bond investors around the world some serious indigestion. The question is, can the U.S. stock market, held up by domestic optimism and the promise of AI-fueled profits, continue to defy gravity? That's the key tension we'll all be watching unfold. Thanks for watching. Don't forget to like and subscribe.